Good morning, teacher.
Morning. Morning, everyone. No, can you hear me?
Yes, teacher.
Yes, teacher, good morning.
Morning. You cannot see me, can you?
No,
I manage the camera to work. Let me do the last one. Yes. Can you see me now?
yes,
Great. How are you? How are you and your family? What are the aftermaths of the rain at home? Everyone okay?
Yes, teacher. Thank you.
Great. We are not complete, and I'm afraid we won't. So I'll give you a choice. Would you like me to go through the answers of the midterm exam, or would you like me to continue with the dividends presentation?
The dividends presentation and then the exam.
Okay, great.
Thank you.
Let me share my screen. Can you see the presentation about dividends now?
Yeah, we can see it.
Yes, great. Okay, so let's review. On Wednesday, we mentioned, let me start here. We mentioned there are 4 types of dividend payments companies can make: a cash dividend, stock dividend, stock split, or share or stock repurchases or buybacks. In a cash dividend, you receive money. You, the shareholder, right? The shareholder receives money in exchange for nothing, just because he or she is the owner of a certain amount of shares. In a stock dividend, you will receive an extra amount of shares depending on the amount of shares you already own. So, for example, stock dividends are usually expressed as percentages. So, 10% stock dividend means that for every 10 shares you own, you will receive 1 more. In Mexico, it's not so common. They are about to regulate it. But in other countries, you may receive fraction shares, which means if you have 5 shares and you are entitled to receive a 10% stock dividend, then you receive half of a share. In theory, shares cannot be divided. They cannot be, in fact, cut or split. But nowadays, it has become more popular and more common that because of those reasons, stock dividends and stock splits in particular, fraction shares are allowed. And that means you will be with someone else. You will be the co-owner of 1 share. You are entitled to half of 1 share, then you will share with another person, with another shareholder, the other half. And when a company declares, for example, a cash dividend on those fraction shares, then you will receive half of the money that you were entitled to receive. Okay, so that is a stock dividend. I repeat, they are usually expressed as percentages. A stock split is a division of a share. They are, in fact, equivalent to stock dividends. Nevertheless, they have different consequences in the balance sheet of a company. I will explain it later. So although for the shareholders, in terms of the wealth he or she receives, there is not much difference between a stock dividend and stock split. For the case of the accountant, there is a difference. So in a stock split, you do not express the dividend as a percentage. You express the dividend as an exchange. For example, the most common one is a 2-for-1 stock split. A 2-for-1 is usually expressed like this. So this is a 2, then 4, 1. This is a 2-for-1 split, which means you will have, not receive, you will have 2 shares after the dividend payment. You will have 2 shares for every 1 share you own. So that means you will receive 1 extra share, right? You may have also a 3-for-2, for example, a 3-for-2 stock dividend, which means for every 2 shares you have, you will receive 1. So in this case, in the first case, so 1 share is divided. Sorry, that was not equal. So it's divided into 2 shares. And 2 shares are transformed into 3. As you may imagine, this has an effect on the price of the share. Why? Because by receiving more shares, there is no change in wealth. So equity is the same. So the same amount of equity divided over a greater number of shares has an effect on the price of what? What would the effect be? My 3 shares, for example, in this case, my 3 shares are worth exactly the same as the first 2, as the initial 2. So if this were worth $100 in equity, these 3 shares are still worth $100 because the fact that the equity of the firm is divided into a greater number of shares, that does not increase nor decrease the value of equity. Do you agree?
Yes.
So if these 3 shares are worth still $100, what is the price per share? So here the price per share is going to be 100 over 2, right? 50. But after the split, $100 would be divided by 3 shares. The price would decrease to 33 1/3. Right?
Yes.
So the effect of a stock split is similar to the effect of a stock dividend. They will decrease, theoretically, they will decrease the price per share because equity does not change. Okay? So this is a split. Stock split. A share repurchase, it's usually announced as a repurchase program in a company. And in that program, the company plans to use a certain amount of cash to buy back shares from the shareholders. So in a cash dividend, the shareholders receive money in exchange for nothing. But in a share repurchase, shareholders receive cash money in exchange for shares. So you have to sell your shares back to the company. And that's why the company purchases or buys the shares back from you, from the shareholder. So that means that in a share repurchase, after the dividend is paid, the number of outstanding shares for the firm decreases. So let's review. In a cash dividend, the number of shares after the payment of the dividend does not change. In a stock dividend, the number of shares after the after the dividend payment increases. In a stock split, the number of shares outstanding for the firm increases after the dividend payment. And in a share repurchase, the number of shares outstanding decreases. Is that clear?
Yes.
Okay. So in any of these type of dividend payments, there is a chronology that should include these 4 dates. The declaration or announcement date, which is the day in which the company announces they will pay a dividend. They will announce that it was approved. They will announce the amount, the type of dividend, the amount of dividend paid, and sometimes, not always, usually, but not always, they would announce the ex-dividend date or the record date and or the payment date. Okay, it's not necessary. Of course, once you announce the dividend, it is known that the other 3 dates are set, but sometimes in the press release, they are not announced. Okay, so we mentioned this. The announcement date corresponds to the date of the press release, to the date of the news, right? Then we have the ex-dividend date or ex-date, which is the day upon which the shareholder loses the right to receive the dividend. So, for example, the date that is marked on the presentation, March the 15th. On March the 15th, shareholders have lost already their right to receive the dividend. So they have to buy the share at least by March the 14th. Okay. And we mentioned there are 2 standards nowadays for the holder of record date or simply the record date. It is usually 1 or 2 business days after the ex-dividend date. So I mentioned that in the CFA paper that I shared with you, it is mentioned that the standard is 2 business days after the ex-dividend date. But today in practice in the market, it's more common probably than the 2-day standard, 1 business day after the ex-dividend date. So the holder of record date is the day in which the company will make a cut-off and will elaborate a list with the names of the shareholders that are entitled to receive the dividend. So in order to be in the record for the dividend, the list, you should have bought shares on, in this example, on March 14th as the latest. So 1 day before the ex-dividend date. All the shareholders that were owners, legal owners of shares 1 day before the ex-dividend date, 1 business day. This is important because if the ex-dividend date is a Monday, then you have to buy by Friday, the Friday before. Okay. So 1 business day before the ex-dividend date, all the legal owners of shareholders on that day will be on the record for receiving the dividend. And finally, the payment date. That is the date in which you will receive cash if your dividend involves cash, or you will receive virtually because you don't receive them physically, you will be notified that you are owner of an extra amount of shares if your dividend includes or involves shares, more shares, new shares. Okay, is that clear? The chronology, the typical chronology of a dividend, because I mentioned this. In the States, if the dividend yield is 25% or more, then the ex-dividend date is 1 business day after the payment date. So you can buy shares 1 day before the payment and you will still receive the dividend. Only if the dividend represents 25% of the return of dividend yield. Okay? Any questions?
No, teacher.
No? Okay. Can anyone remind me what is a cum dividend date? Or could you give me an example with the information you have on the screen? Could you give me an example of a cum dividend date? Could you tell any day that is a cum dividend date?
Is the period after the February 24 and before the March 15?
It could even be before February 24th, right?
Yes.
It is a period between the last paid dividend and 1 business day before the ex-dividend date for the following dividend. Yes? Right?
Thank you, teacher.
Yep. Was that clear?
Yes, teacher.
Teacher, can you repeat it, please?
Mm-hmm. The cum dividend date is the period of time between the last paid dividend and 1 business day before the ex-dividend date for the following dividend. So, for example, here, so March the 14th would be the last business day with cum dividend, with the right to receive dividend. And the cum dividend date would go back until the previous dividend. Okay.
Yes, thank you.
All right. Any other question? Okay, so that is the chronology, X and cum dividend dates, and the types of dividends. Now, according to what the company shares, according to what the company distributes and how it is distributed, dividends are classified into cash, stock dividends, stock splits, or share repurchases. Or according to how regularly the company pays a dividend, dividends may be classified as regular, extra or extraordinary, and liquidated dividends. Regular dividends are dividends for companies that have a policy of paying, for example, every year, every quarter, every semester. So they are paid periodically on a regular basis. Okay? An extra or extraordinary dividend is paid for companies that may or may not have regular dividends. So it means a company that pays regular dividends may also pay extraordinary dividends. But a company that does not pay regular dividends will usually pay only extraordinary dividends. Is that clear what I said? Guys, is that clear? Hello?
Yes,
Yes,
teacher.
teacher.
I need you to answer because then I don't know if I lost the connection or not. So you could please just answer it so that I know that we are still listening to each other. Okay. Okay, so where does an extraordinary dividend come from? It may come from cyclical sales. So because I am a very cyclical company and I have a high uncertainty on the amount of cash flows I will have available to pay dividends, then I do not declare regular dividends. So whenever I have money, I declare an extraordinary dividend. So maybe I will pay this year, and the next year I won't because I don't have cash. And probably in 3 years' time I will pay one again, etc. So cyclical sales. Another cause of extraordinary dividends is the sale of obsolete assets, or not necessarily obsolete, but unused assets, usually fixed assets. So I have a pool of trailers and lorries, and I don't use them anymore. They became too expensive for me. I bought new ones with a new technology, which can require less fuel, for example, so they are cheaper in my operation. So I'm gonna sell those lorries, and that would probably generate a profit. So I may decide, I mean the board of directors and the shareholders may decide to distribute the profit on that sale. So they would declare an extraordinary dividend. So it's, an extraordinary amount of cash that for some not ordinary reason, okay, the company generated. Is that clear? An extraordinary dividend? Maybe we sold part of the company. Okay. And then we have a profit that we want to share with the shareholders. And because that cash flow won't be regular, because the sale of a part of the company, a business of the company, is not something you do every year, of course. Then that extra amount of cash, if approved, may be distributed as an extraordinary dividend. They are also called special dividends, extra, extraordinary, or special dividends. Okay. And finally, when you close down your company and you make profit because you sold everything you had, you will distribute not only the profit, but whatever proceeds there was as a liquidated dividend. Or probably you close down once more a part of the company, one business line or a couple of business lines, because you decided that you want to concentrate on certain market only, or you want to concentrate on certain products or services, or you deem that those business lines may be decreasing in sales and they do not represent good business for you. So you sell that part of the business, you liquidate it. Okay. All right.
Yes, teacher.
Yes, teacher.
Great. So I mentioned that stock dividends and splits are basically the same. Stock dividends are expressed as a percentage on the number of shares already outstanding. Okay, and the split is represented as a ratio. The only difference is that stock splits represent a reduction in the par value or book value of the shares when they are registered in the balance sheet of the company. Well, you won't see it in the balance sheet. They will be only in the books of the company, in fact. And the stock dividend represents a transfer from retained earnings to equity capital. Do you understand what that means?
No, teacher.
No? Okay, let's give an example to see. So let's go back to this 2-for-1 split. Let's say permanent one second. So 2 is 2-for-1. So 2-for-1 split. So let's say the book value of the share was $50 before the split. Okay. So if this is a stock split, and I know because of this ratio, it means that now after the split, the book value of the share is going to be 50 over 2, 25. Okay. Equity remains the same. So in the balance sheet of the firm, I have liabilities and equity. I have a common stock, which is the book value of shares. I have retained earnings. And sometimes you see the companies report the surplus or the deficit, the value of the shares. So the par value is here in common stock. There is no difference. If the company had 1 million pesos of common stock, after the repurchase, there will be still 1 million pesos. The only difference is that the par value of the share will decrease in proportion to the number of new shares. Okay. Nevertheless, if this was a stock dividend, a stock dividend equivalent to a 2-for-1 share would be how much percentage? So in a 10% stock dividend, if I have 100 shares, I get 10 new shares. Okay. If I had 1 and I get 1 more, what is the stock dividend percentage?
$100.
Yes, that's right, 100. A 2-for-1 split, a 2-for-1 stock split is equivalent to a 100 stock dividend. Okay, these are equivalent. Right? So what happens in the balance sheet? When a company declares stock dividends, there is a transfer from retained earnings to common stock, the par value. So for every share, how much money do we have to transfer from retained earnings to common stock? So let's say the company had 1 million pesos in common stock and 500,000 in retained earnings. So what happens if the company declares a stock dividend? Nothing changes here, absolutely nothing. But if the company declares stock dividends at a ratio of 100%, what would happen in these two accounts?
The common stock will increase
By how much? Yes, it did. By how much? How much money is involved in the dividend?
I don't know how to say it in English. It's 100,000.
$100,000?
Yes. I think.
How did you come up with that number?
Because the common stock is already $100,000, and if the stock dividend is the ratio is 2/1, or how can I say it?
Yeah, the stock split is 2-for-1. That's right.
2/1.
But the common stock is 1 million, not 100,000. No?
1 million. 1 million. Okay. Yes. And if it's the 2/1, is the same amount, but twice.
How many shares are there? How many outstanding shares does this company have? We go to another page. It's too much. So I have common stock, 1 million. I had book value of 50 before, right? Before the dividend. So in my balance sheet, originally I have common stock, 1 million. Retained earnings, 500,000. Right? That was before the dividend. What's going to happen after? How many shares does this company have? If
2 million.
common stock, how many?
After the split, it has 2 million.
I didn't hear that. Could you repeat how many? So if currently the company has $1 million in common stock and the book value is $50, 1 million over 50 should be the number of outstanding shares. Do you agree?
Yes,
Yes
it's
or no?
20,000.
20,000?
Yes.
Isn't it 200,000?
Yes.
200?
No, it is 20,000.
20?
Yes.
There it is. Okay, so this company has currently 20,000 shares. After the stock dividend, we declare a stock dividend of 100%. Right? How many shares outstanding there would be after the dividend? How many outstanding shares?
40,000?
40,000, right? The double, right?
Yes, because it's 2-for-1.
It is a 2-for-1 split, but it is 100% stock dividend. So for 1 share, I will get another one. If this was a stock split, then I would divide $1 million, which is the amount of equity, over 40,000. That gives me $25 per share. Is that right?
Yes.
Okay.
Yes.
Now, in the stock, and nothing changes. After the dividend, common stock is $1 million and retained earnings is $500,000. But in a stock dividend, I have to transfer money from retained earnings to common stock. How much money? The amount of money that is worth the dividend. So how much money do I have to transfer from this 500,000 to this 1 million?
The 40,000 shares.
40,000 is going to be the total number. The dividend is only 20,000, right? In the dividend, I'm going to give 20,000 shares or more. 40,000 is the total if I add the shares before the dividend and after the dividend, right?
Yes.
So the dividend itself involves only 20,000 shares more. Would you agree?
Yes.
Now, how much are these 20,000 shares worth?
500,000.
500,000? How did you come
Yes.
with that number?
Multiplying the new shares, like the 20,000 shares, times the book value of the shares.
And what is the book value?
$25, because we already did the stock dividend.
And you said that is 500,000?
Yes.
Did you agree?
Yes, teacher.
So it means that after the dividend, I'm going to have $1,500,000 in common stock and 0 retained earnings. I transfer $500,000, which is the amount that the dividend is worth. All right?
Okay.
Yes.
So let's repeat. In a 2-for-1 split, the balance sheet does not change. What changes is the book value per share. Okay, book value is 25 instead of 50, but balance sheet does not get altered. In the stock dividend, both the book value of the share decreases and there is a transfer of money between retained earnings and common stock. But you see, for the shareholder, there is no difference. The shareholder will receive 1 new share for every share he or she already owns. The only difference between stock dividends and stock splits is how the company must register the dividend in the statements of the company. Okay?
Yes, teacher.
Questions? Now let's do this exercise. Finish line announces stock split and cash dividend. This was October 21st, 2004, Indianapolis, okay? Finish Line Incorporated announced today, so October 21st, 2004, that its board of directors has declared a 2-for-1. This is another way of expressing a split instead of the ratio I show you with words. 2-for-1. A 2-for-1 split of the company's Class A and Class B common stock. On November 17, 2004, stockholders will receive one additional share of common stock for each share of common stock they own on the record day of November 5th, 2004. The company expects that its outstanding Class A common stock will begin to trade on a split-adjusted basis on NASDAQ, which is the stock exchange, on November 18, 2004. On a split-adjusted basis, the company will have approximately 42.7 million shares of Class A and 5.7 million shares of Class B outstanding. Is there any question on that text? Because the article is not finished yet, but is there any question? Do you understand everything?
Yes,
Probably this is important that I mention. In a stock split, the first number that is mentioned is the final number of shares a shareholder will have. And the first number mentioned, first figure, is the current number of shares the shareholder should have to get the new shares. Because we also have something that is called the reverse split. Sorry, sometimes I have to write with other tool. Reverse split. Okay. In a common or normal split, you get more shares than the initial shares you have, or the company ends with a number of outstanding shares greater than the initial number it had before the dividend. But in a reverse split, it's the other way around. For example, a 2-for-3, which means for every 3 shares the company had outstanding, after the payment, the dividend payment, there will be only 2. So in a reverse split, the number of outstanding shares for the company decreases, and also for the shareholder, of course. In the States, they had a rule for something that was called, or still called, the penny stocks. Penny stocks are stocks which are worth less than $1. So they are worth cents, pennies. Okay? Shares that are worth cents for quite some time are deemed to be trash. And companies are not allowed to have a market price for their shares below $1 for a long time. So they are forced to conduct reverse splits. Why? Because if I have, let's say the price of a share, it's currently $0.5, 50 cents. What would be the price of one share after a 2-for-3 split? So let's make the numbers. If I have 3 shares at a market price of 50 cents, I have equity worth $1.5. Do you agree?
yes,
So I still will have $1.5 after the split, but that would be divided by only 2 shares. The share price will rise to 75 cents. Not enough. So maybe I am forced to do a 2-for-1. In a 2-for-1 split, In a 2-for-1 split, one share was 0.5. Sorry, and it's the other way around. 1-for-2. In a 1-for-2 reverse split, 2 shares worth 50 cents give a total of $1 in equity. Now, $1 in equity after the dividend will be divided by 1 share. Now I have a share worth $1. It's not a penny stock anymore. So that is the reason reverse split exists. The effect is to increase the market price of the shares. An increase in the market price of shares is useful for at least 2 purposes. One, regulation, because penny stocks are not allowed to be maintained for a long time. So you are forced as a company to conduct a reverse split. And even if your share is not a penny stock, reverse split has the favorable effect of increasing the price of your share. If your share becomes more expensive, then the market, the profile of investors that may buy your share is different. So a cheap share may be bought by anyone, but expensive shares can only be bought by certain profile of investors, such as pension funds or institutional investors or people with money, right? So a different profile of investors. Okay, is that clear what I'm saying? So a reverse split is also a type of dividend, but it's in the family of stock splits. Okay. Did I explain myself?
Yes, teacher.
Okay. Let's continue. Now, Alan Cohen, which is chairman of the board of board and chief executive board of directors and chief executive officer of the company Finish Line, stated or said that the board's decision recognizes our strong growth record as well as the significant long-term opportunities we believe lie ahead. Further, the board is committed to actions that can contribute to the total return to our stockholders. And I highlighted this in red. We, so the company, we believe this split will enhance liquidity and make our common stock more attractive to a broader range of investors, which is exactly opposite to what I just said about inverse or reverse split. A normal split has the effect of reducing the price of a share. By reducing the price of your share, you make your share cheaper. Cheaper in the good sense, right? I'm not using this sense that is not worth, right? Cheaper in the sense that is more affordable, right? So if the price of a good is lower, gets lower, it is more liquid. Do you agree? It is because it is easier to buy it and sell it, right? Do you agree? Yes or no? Yes, okay. So if a good, in this case, a share, reduces its price, it would be easier to sell it and buy it, and therefore it becomes more liquid. So in that sense, the CEO of the company says the split will enhance the liquidity of our share, of our common stock. Okay. And by doing so, more people may be more people can afford to buy the share. So it will become more attractive to a broader, larger number of, to a broader range of investors. So that is what is in red is the usual effect of a normal stock split. It will enhance liquidity and it will make the share more attractive to a larger number of investors. Okay? It's absolutely opposite to the reverse split. Okay, is that clear?
Yes.
All right. Now, apart from this split, from this 2-for-1 split, the company announced a quarterly cash dividend of 5 cents or 2.5 cents, split adjusted, per share of Class A and Class B common stock. The quarterly dividend will be payable or was payable on December 15, 2004 to stockholders of record on December 1st. So we have a few questions to answer regarding this announcement. One, what type of dividends is the company announcing?
Cash dividend.
A cash dividend? Only?
It's a split also.
That's correct. So we have a 2-for-1 split and also a cash dividend. Okay, so the company is announcing at the same time. If you look at the title, this I didn't choose the title. The title was the title of the article indeed. So this is the article title. It was a news wire, so it was a electronic newspaper. Okay. So the company is announcing 2 types of dividends: a cash dividend and a stock split. Okay. Now, for the stock split, what is the chronology? Let's remind us the chronology must have a declaration date, an ex-dividend date, a holder of record date, and a payment date. Okay, so when you are asked for the chronology, you should provide 4 dates. So what is the chronology for the split?
It was first announced on October 24th.
That's correct. So the announcement or declaration date was October 21st, 2004. Correct. Because it says it is announced today. When was today? October 1st, 2004. What else? What's next? Announcement, then?
I think the ex-dividend date is November 16. The ex-dividend date.
Why did you choose November the 16th?
Because it's the day before the dividend is entregado.
Delivered? Okay.
Yeah.
So 1 business day before the dividend is paid, you mean?
Yes. I don't know if it's correct.
Look at the chronology here. Is it correct? The day in which the dividend is paid is the payment date.
Okay.
Is the exhibiting day one business day before that date?
No. No.
So let's look for another one.
Isn't it November 4th? Because it says the stockholders will receive one additional share on the record date of November 5th. So
You said November the 4th?
excuse me?
Did you say November the 4th?
Yes.
What standard would you be following?
Can you repeat that, please? I didn't
What
hear.
standard would you be following if November the 4th were the ex-dividend date?
Well, because on November 5th, we can say you lose the right to, for example, if you buy one share on November 5th, you won't get the split. So you have to buy either one Series A or Class A or Class B share before November 5th. So I choose November 4th.
But if November the 4th were the ex-dividend date and you bought the share on that date, you would not receive the dividend either. Are you following me?
Oh, so yes. So is it November 5th?
November the 5th is already in the chronology. What date of the chronology? What date of this chronology is November the 5th?
The record.
The record date. Huh? And by definition, the ex-dividend date is usually
Like November 3rd, it has to be 1 or 2 business days before the record date.
That's correct. So the ex-dividend date is 1 or 2 business days before the record date. Because the record date is November the 5th, if we follow the 2 business days convention, then the ex-dividend date would be November the 3rd. If we follow the standard of 1 business day before, it will be November the 4th. Okay?
Okay, teacher.
So, declaration day, October 21st. Ex-dividend date, let's follow the 2 business day before convention, okay? November the 3rd. Holder of record date, November the 5th. We're only missing the payment date for the stock split. What date would that be?
November 17. No.
That's right. November 17th, because that's when you will receive the additional share, which is the 2-for-1 split. All right? Was that clear for everyone? So let's review. Declaration date, October 21st, 2004. Ex-dividend date following the 2 business day standard would be November the 3rd. Holder of record date would be November the 5th. And payment date, November the 17th. Is that clear for everyone?
Yes.
Now tell me, what is this November the 18th? What happens on that day? Is the date relevant? Shall I just ignore it? Is it important for any reason? If it were irrelevant, why are they mentioning it. So what happens on November the 18th? What happened?
Like the number of outstanding shares will increase?
That's right. And that is the split adjusted basis. Up to November the 17th, shares will trade at the current price. But as from November the 18th, the number of shares will increase because the dividend would have been paid and the share price would decrease. That's what happens on November the 18th, and it is relevant because of that. Because any transaction as from November the 18th could take place at a new price, lower new price. Okay?
Yes.
So it is not part of the chronology of the dividend, but it is relevant for the company and for the market. Okay, so question number 3. What was the number of outstanding shares before the split? What was the number of outstanding shares before the split?
So I think they had 21.35 million shares of Class A and 2.85 million shares of Class B.
Correct. Does everyone agree? Is there anyone that doesn't understand where those numbers come from?
Hey, can you repeat that, please?
Here? Can you repeat it, please?
I had 2.85 million shares of Class B and 21.35 millions of Class A shares.
That's correct. 21.35 million shares of Class A and 2.85 million shares of Class B. That was the number of outstanding shares before the split, after the adjustment. How do we know it was half? How do we know?
Can you repeat the question, please?
How do we know the number of outstanding shares before the split was half of
We
the
have
name of the number mentioned?
yes. So we have 2-for-1 split, and we have the outstanding shares after the split. So we can just divide the outstanding after outstanding shares divided by 2. So we have the shares before the split.
So this 2-for-1 split means that for every share outstanding after the dividend, there will be 2. So the double. So the number of outstanding shares will double after the split. If after the split, one share has 42.7 million shares, one class A, then before the split, the number of shares was half of that. Is that clear for everyone? That's why we divided by 2.
Yes.
Good, excellent. Questions? Any other question? According to the theory, what is the effect of this stock split on the stock price? So what is the theoretical effect of this stock split on the stock price? What split? These 2-for-1 split. On which shares? Class A and Class B common stock for finish line. What is the theoretical effect on the stock price, on the market price?
It will decrease.
It will decrease. By how much? By how much?
By 2%.
Sorry, can you repeat that?
The half.
By half, yes, exactly. The number of shares will double. The theoretical share price will half. Okay? Will be divided by 2. All right? Why do we mention theoretical effect? Well, because of this. Although the theoretical effect establishes or states that the price of the share will be half of what it was before, the liquidity premium will cause the price to decrease, but not by half, by less than that. That's what we will usually observe in reality. Okay? Exactly what I said? So if the price was 10, we might see that the price decreases to 6, not to 5, probably. All right? Is it clear what I'm saying?
Yes.
Yes.
And because of that, a stock split can result in profit for shareholders. Why? Because by selling units that have a unit price higher than the unit price before the dividend, they make a profit. They gain money. You know what I mean? You understand what I'm saying? So before I had one share worth $10. If after the split I have 2 shares worth $6 each, I have a wealth of $12 instead of 10 in practice. In the theory, you will have $10. Okay, theory states that there is no gain in value. There is no increase in wealth. But practice is different from theory sometimes. And this is one of those situations in which practice differs from theory. We see very often that stock splits result in a unit price higher than the unit price before the dividend. And that's called the liquidity premium. Liquidity premium is the result of a stock split in which the unit price makes a wealth greater than the wealth before the dividend. Is it clear what I'm saying? Do I explain myself? Hello?
Yes, teacher.
Okay. All right. So the theoretical effect, the stock price will decrease by half. Now, about the cash dividend. What is the chronology on the payment of the cash dividend? We need 4 dates: the announcement date, the ex-dividend date, the record date, and the payment date. Are they the same? Does this cash dividend has the same chronology as the stock split?
No.
No.
No, no. So what is the chronology for the cash dividend?
So the announce date is the same that the stock split. I think
That's
it was
right.
for 21st.
They are announced at the same time. They say it is also announced. And it was announced on October the 21st, correct? So the announcement date is October 21st, 2004. What else do we know?
The ex-dividend day, I think, will be the, well, I don't know if November has 30 or 31 days, but it's
30,
2 days
30.
before. It's
30 days.
the 29 of November, November 29.
Okay, following the 2 business day standard or convention, the ex-dividend date could be November the 29th. Provided November 29, 2004 was a business day, right?
Yes.
So what else do we know?
The record date,
Which is
December 1st.
correct. December the 1st, the record date. And finally,
The payment date, which is December 15th.
correct. Excellent. So just review. The declaration date for the cash dividend, October the 21st, 2004. The ex-dividend date, November 29th. The holder of record date, December the 1st. The payment date, December the 15th. So the only date that the cash dividend and the stock split have in common is the declaration date. As you can see, they have a completely different chronology. So finally, when do shares start trading on a split adjusted basis? When do shares start trading on a split adjusted basis?
November 18th.
Correct. And we already explained that that means that as from that day, including that day, the price of the shares would be, in theory, half it was before. And any transaction would take place at that price or any market price. Okay?
Okay.
So far, so good. Is there any question about this exercise?
Not sure.
Okay. I am going to share this exercise in the files of the class. And I would like you to try to answer it as homework. We will practice on Monday, okay? But it would be good if you give it a try during the weekend or before class on Monday. Okay? Let me do it
Okay.
now. Let me do it right now. So that I have some time to explain the answers for the midterm exam. So there you have it. Okay. So in general, you did very well in the midterm exam. So congratulations on that. Well done. Let me go first to the American Mobile issue. All right. So quite a few questions about an issue on debt. It was debt because they were nuts for American Mobile. So are the securities being offered debt securities or equity securities? Let me go to the prospectus. In fact, it is only the cover of the prospectus. Prospectus is quite long. So the answer should be they are debt. It is a debt issue. And the explanation or the details should include any of many characteristics. So the issue has many characteristics which are just limited to debt issues. For example, notes. The denomination note, it's only for debt. It's not for equity. They offer interest rate. Only debt issues offer interest rates, okay? They have maturity dates. So this is a feature exclusive for debt issues. So any of those reasons, and they were all the people mentioned obligations. Yes, indeed, obligation is a denomination that is only used for debt. It is an obligation to repay, another characteristic for debt securities. So there were quite a few features, characteristics that you could have mentioned to explain or to fundament your choice. Okay, so this is a debt issue for any of those reasons. Okay, why are they senior? Well, it was a little bit confusing for some of you. The last note, which is kind of long, but indeed they are senior. First, because they are explicitly classified as senior notes. And probably the explanation should have included why they are senior or in which cases they are senior and in which cases they are not. Okay. America Mobile is the holding of Radio Móvil DIPSA, as you can read here, right? Radio Móvil DIPSA, which is Telcel, is a subsidiary of this company. This company is America Mobile. So as you can see, America Mobile is a holding company, which is a group, a corporate group, which has other companies, being one of those, Radio Móvil DIPSA, which is Telcel. Okay. So the notes are senior because they are unsecured and unsubordinated. And they are senior to all other debt securities of America Mobile. They are not senior for the debt of Telcel. Okay, so you could have stated, no, they are not senior for these securities, but they are in fact senior. Okay, so you cannot say in absolute terms that these notes are not senior at all. No, they are senior. They are senior because they are unsecured, because they are unsubordinated, because they rank equally to all other debt of the company. But you could have mentioned, as some of you did mention, nevertheless, they are not senior for debt securities of the subsidiaries such as Radio Móvil DIPSA. I think this is one of the questions which created most confusion. I don't know if the explanation I just gave makes it clear now. Is it clear why they are senior? Yes? Does anyone have a question?
Yes.
Yeah, is it clear now? So yes, they are senior, and I just explained there are certain conditions under which they are not senior. Okay, but that refers to the subsidiaries. Okay. Let's see. Is the yield to maturity lower than 5% per year? Question. Tell me what condition must be met for the yield to maturity of a bond to be equal to the coupon rate. What is the condition for that to happen? Under which circumstances the yield to maturity of a bond is exactly equal to the coupon rate? When? Anyone?
I think is when the face value equals the nominal value of the bond.
That's right. When the price of the bond equals the face value of the bond, then the yield to maturity will be equal to the coupon rate. If the price of the bond is lower than the face value, the yield to maturity will be higher than the coupon. If the bond price is higher than the face value, then the yield to maturity will be lower than the coupon rate. So you don't know the price, but you know the price is 99.774% of the principal amount or face value, which means whatever the face value is, the price of the bond is lower than the face value. For that reason, this coupon rate, the 9.5 is the coupon rate, is the interest rate, is not the yield to maturity. Okay, so the coupon rate is 9.5, being the price lower than the principal amount, than the face value, then the yield to maturity of these notes should have been higher than 9.5, which was the coupon rate. Is that clear? Hello?
Yes, it is.
Yes, teacher.
So the answer was higher. The explanation I just gave. The price is lower than the face value, which is 99.77% of the face value. Therefore, the yield to maturity has to be higher, not lower, than 9.5, which is the coupon rate. Okay. Next, is the coupon rate? Is the coupon of the notes payable monthly? The answer is no. The explanation is that in the prospectus, it says in the payment dates that interest, which is the coupon, will be payable on January and July each year. So semi-annually, not monthly. All right. Questions, doubts?
No, teacher.
Next. I found this interesting because some of you answered incorrectly to this question, which I thought was very easy, but now I realize it was not that easy. Is this a floating rate security? The answer is no. Floating rate or floating rate or fixed rate refers to the coupon rate. The coupon rate is fixed, 9.5% per year. That is fixed. Now, these notes that cause the confusion is the calculation of interest. That's it. Many people, or not many, some of you answered that it was variable because of this number of days. But that's different from the coupon rate. Okay. Now, as we know, a year has 365 days. So if we divide the year in two, we won't have equal semesters or semesters with equal number of days, right? Because we have an odd number of days in the year. It's not a pair number, per figure, okay? So this means that the interest rate that is fixed, 9.5, will be divided by 360 to obtain the daily interest rate. And then it will be multiplied by the number of actual days in the semester. which may be 182, 183, 181. But that doesn't make the bond, the issue, a floating rate bond. The rate is fixed. What changes is the number of days in the semester. Is that clear?
Yes.
Yes, it's clear.
Yes.
But the rate is fixed. It is a fixed rate bond. All right? Great. Next question was, is this a Eurobond? Depending on the explanation, the answer may be yes or no. Okay? The answer is no if you explain that it is not a Eurobond for the Mexican investors. Because the bond has not yet obtained the approval of the Luxembourg Stock Exchange, and therefore will be only offered in the Mexican Stock Exchange to Mexican investors. Because it would be listed in the Mexican Stock Exchange, that is in Mexico, in Mexican pesos. Under those conditions, it is not a Eurobond, it is a domestic bond. But you could have answered no and yes. No for the Mexican, but when the bond gets the approval of the Luxembourg Stock Exchange, it could be Eurobond for the international investors because the issue is denominated in pesos and will be sold outside Mexico. So depending on the reason you gave, several or these two answers may be plausible. Okay? Is that clear? But then I had contradictory answers because some of you answered, no, this is not a Eurobond because it is only offered in Mexico because it is not offered in Luxembourg yet. So it's only offered in Mexico, but then you answered, yes, it is a global bond. It doesn't make sense. Your answers are opposite. If you answer, no, this is not a Eurobond because it is only offered in Mexico to Mexican investors in Mexican pesos, then you should have answered, this is not a global bond. But if you answer, yes, this is not a Eurobond, but yes, this is a global bond because they are applying to the Luxembourg and they will be sold in Europe or international. Then that nullifies your previous answer. I didn't get it. I mean, I assessed the two questions independently, but I just want to make this comment because you have to be consistent in your answers. And you have to be consistent in your word life. You cannot say, well, you should not. You can, of course, but you should not say no and then change in the next line and change to an opposite, a totally opposite point of view, right? So to answer letter G, is this a global bond? Once more, depends on the explanation you gave. If you answer, no, it is not a global bond because it has not been yet approved outside Mexico, correct. But you could have answered, yes, it is a global bond because first, it is said here that they have been offered concurrently. Concurrently means in Mexico and somewhere else, okay? It's not been yet approved, but it will be offered outside Mexico. So therefore, it is a global bond, correct? Okay, so similar to letter F, depending on the explanation you gave, you could have answered no or yes, no or yes. And you could have, you had the correct answer because I had different answers and they were correct depending on the explanation you provided. Okay, is that clear? Just please, for the following cases, for the rest of your lives, try to be consistent, okay? Try not to be contradictory because that confuses your clients, your bosses, your family, your friends, okay? Everyone, your teachers, me, okay? Finally, is this issue a callable bond? The answer is yes. Why? Because in the prospectus. There is, no, I think it's not in the prospectus, right? It is. I think it was in the description, probably. Yes, here. In the description, it says prior to October 27, 2030, which is 3 months prior to the stated maturity, they, the company, may, at their option, redeem the Mexican pesos notes in whole or in part. So it means they are redeemable before maturity, so they are callable bonds because it is the option for the company. Okay, that's the explanation. All right, so far so good. Any question on this first exercise? Anything that I could not explain properly? Guys?
It's all good.
For me, it's okay.
Okay. Can you see my screen? Yes?
Yes.
Your screen, yes.
You can see the screen and you can see me as well at the same time, right?
Yes, teacher.
Yes.
All right. So part 2, one exercise about WAC, one exercise about portfolio. So let's go through the WAC exercise first. It was very easy. I didn't give you the exercises I like to. Okay, nice. You did well. So that's the good thing. All right, so we have a company that has 2 types of debt, one's a bank loan, different types of interest rates, risk beta for the bonds, not for the loan, market values, and book value. For equity, we know the beta, we know the book value and the market value, but we don't know the cost because that's something we need to estimate. We were asked both WAC and the average cost of debt. Let me just double check in which order. Okay, first the cost of debt and then the WAC. I think I did it the other way around. Yeah, I did it the other way around. So for the average cost of debt, we have to estimate it as a weighted average only for the components of WAC. So that means that I have to make the weights just considering the market value of debt, which is 50 and 15. So in terms of market value, the company has 65 million pesos of debt. 50 out of the 60 gives you this 0.769 as the weight for the bonds and the remainder. The remainder, 23%, 0.23 is the bank loan, so which is 15 over 65. Okay. The cost of debt for bonds is 10.5. It's given us information. The bank loan has an interest rate of 14%. The question was the cost of debt before taxes. So before taxes, we only need to calculate the weighted average. So 0.76 times 10.5% plus 0.23 times 14%. The sum of the product of the weights and the interest rates provides a weighted average cost of debt of 11.31, approximately 11.37% per year as the cost of debt before taxes. Okay. And then we were asked to determine the minimum return required for a new investment, which will be financed with the current capital structure. If the investment is financed with the same capital structure, then we need the current WAC. So that means that these betas, particularly for the debt, are irrelevant because we are not going to change the capital structure. We are not going to change the financial risk of the firm. Therefore, we just need to calculate the current WACC for the firm. The current, which means using the current components and the current market value. We are only missing the cost of equity. But we were given as information the market return, the risk-free rate, and the corporate tax rate. And of course, the equity beta for the equity financing of the company, the equity capital. So first, we estimate the cost of equity using the CAPM, which is 11%, the risk-free rate, plus the beta 2.1 times the market risk premium. Because I don't have the market risk premium, I had to make the difference. Market return minus risk-free rate, so 15 minus 11. And that results in a cost of equity, according to the CAPM, of 19.4%. Now I will use the total amount of debt and equity in market value, which is 95 million pesos, to get the weights or the three components of debt, the three components in the WACC, in the capital structure. So 50 million, which is the bonds, over 95, which is total value of the components of WACC, 0.52, 15 over 95, and 30 over 95. If I add up all the weights, I should get 1. A couple of you did something strange when you calculated the cost of debt. You did not check that the weights or the weighted average added up to 1. And that, of course, led you to a wrong cost of debt. So when you calculate that weighted average, you should double check all the time that the weights of the components you are using in the average should add up to 1. Okay. So the weight times the interest rate minus the tax rate in the case of the bonds and the back loan. Of course, for the cost of equity, we don't have deductibility of taxes, therefore we don't have a saving in taxes. The weighted average cost of capital is 11.54, which is the current WACC, which is the cost of capital at which we have to assess any new investment using the same capital structure. Okay, so 11.55%, means 54% figure. Is there any question about this exercise? The average cost of debt, the weighted average cost of capital. Some of you use the book value. Remember that for WACC, we have to use market values. Okay. Questions? No? Is everything clear?
All good, teacher.
Of course, you could have used the average cost of debt that you calculated. I didn't use it like that, but you could have used the weighted average cost of debt after taxes times the proportion of debt, which would be 65 over 95, and then add the proportion of the contribution of the cost of equity, and you will get 11.54%. Okay, so you don't have to do it as I did it. You may use the cost of debt. So let me do the cost of debt after taxes, plus the cost of plus the proportion 65 over 95, plus the cost of equity times the proportion of equity. Okay. So it's exactly the same number, you see? So the weighted average cost of debt after taxes times the proportion of debt in the company, which is 65 over 95, plus the cost of equity times the proportion of equity, which is 30 over 95. you get exactly the same number as I did. So let's go for the portfolio theory exercise. These are ETFs and they are real. Okay, that's the description of each ETF. One follows the Mexican Stock Exchange, the other Standard & Poor's 500, the Euro Stocks 50, which is a European index, and an Asian stock exchange index. Okay? So you would have a well-diversified, at least geographically, you could have a well-diversified portfolio if you chose those ETFs. Okay, the risk-free rate is 11%. You can borrow and lend at this rate. You have, or someone has 1 million pesos to invest, is aiming for a 12% annual return. What shall he or she do? Because you are allowed to borrow and lend money at the risk-free rate, then the most efficient decision you can make, the best recommendation we can make, best decision the investor can make is any portfolio along the efficient frontier. With borrowing and lending at the risk-free rate, the efficient frontier is a straight line, whose slope is the Sharpe ratio of the optimum portfolio, right? And we were given the information of the optimum portfolio. We have the standard deviation and the composition of the optimum portfolio. We don't have the return, but we know that the return of any portfolio is the weighted average of the return of the individual assets. Okay. So what does that mean? We need to find the equation of the efficient frontier. In order to get the efficient frontier, we need the Sharpe ratio of the optimum portfolio. In order to get the Sharpe ratio, we need the return for the optimum portfolio. So the weighted average of the 4 ETFs and their proportions in the optimum portfolio provides an expected return for the optimum portfolio of 30.61%. So how do we get that? Is the proportion of the NASDAQ in the optimum portfolio times its expected return. The proportion of IBV times its expected return, and so forth. The sum of the proportions equal 1. Okay? So the expected return of the optimum portfolio, 13.61. With that, I can estimate the Sharpe ratio as the return on the optimum minus the risk-free rate divided by the risk of the optimum portfolio. Because I am using decimal numbers, I divided the 15.5%, which is the standard deviation of the optimum portfolio, by 100. I repeat, because I am using decimal numbers. But if you use numbers, 15.5, 13.6, 11, you didn't have to divide by 100, okay? So the equation of the efficient frontier is 0.11 plus 0.1687 standard deviation of the portfolio. So any portfolio along the efficient frontier has a return that is a result of applying that equation to its risk. Okay, because the Sharpe ratio is 0.1687. Now, along that frontier, I am looking for a return of 12%. I know that the return follows the efficient frontier equation. I substitute 0.12 as the return on the portfolio, and I solve for the standard deviation of that portfolio that will produce 12% return. Okay, so I repeat, in this equation, in the equation of the efficient frontier, I substitute RP for 0.12. And I solve for SP. S is for standard deviation, should be sigma, though. I am lazy, I didn't change it. Okay, so this is sigma, right? That's better, okay? So the return on any portfolio follows this equation. I substitute 12% as the return, and I look for the risk of that portfolio. The risk is 5.92% or 0.059. I also know that when I combine a risky asset like the optimum portfolio with the risk-free rate, the risk of that portfolio, the risk of the combination of all those assets is simply the risk of the optimum portfolio times the proportion of the optimum portfolio in my target portfolio. Okay? So let me change here so that it is clearer. So I repeat. The risk of any portfolio along the efficient frontier with borrowing and lending equals the risk of the optimum portfolio times the proportion of the optimum portfolio in the target portfolio. Okay. I know that the risk of the optimum portfolio is 15.5%. I know that the risk of my target portfolio is 5.9%. I solve for the proportion of the optimum portfolio in the 12% portfolio. That is 38%. Because along the efficient frontier, I am only combining optimum and risk-free. If the optimum takes 88% of the portfolio, then the risk-free rate is 1 minus that. So 61.75% should be risk-free rate. Okay? So because the proportion of the optimum is positive, it means I am on the lending part of the efficient frontier. Is that clear? Because the proportion of the optimum portfolio is positive, it means I am lending money and investing in the optimum portfolio. I am not borrowing. So how much money shall the investor invest in each of the assets? Because the optimum is 38%, and inside the optimum, 5% is NAFTRAC, then I multiply 38% times 5%. And I get 1.91% in the target portfolio of NAFTRAC. I do the same for IBV, FS, BPL. And I already know that for the risk-free rate was this 61%. Then I multiply the proportion times 1 billion pesos. And this is the amount of money the investor should put in each of the assets. The question was, how much money? Okay, so the answer should have been this amount of pesos, this amount of pesos, this amount of pesos. Okay, this is just my proof. Okay, this is how I prove that these proportions are correct. If I invest this proportion of each of the ETFs on the risk-free rate, I will get a 12% return, which was mine. Okay, so the answer is this: 19,000 pesos in NAFTRAC, 248,000 in IPV, 38,000 FES, 76,000 BPL, and 617,000 in the risk-free rate. That adds up to my $1 million of investments. Right? Some people got the Sharpe ratio wrong, and getting the Sharpe ratio wrong, then you get everything. Some people got the Sharpe ratio correct, but for some reason, they mixed decimal numbers with integer numbers or something like that, or they simply miscopied a number from the calculator and they got the standard deviation of your target portfolio incorrect. So just be careful with the calculations. I know you don't have much time to review and to double check, but the more consistent you are, much more consistency, the more ordered you are, because sometimes the lack of order in the exam makes you make mistakes. So if you are ordered and you follow a method, you reduce the probability of mistakes. Okay. Questions about the second exercise? Folios?
No.
Right. So if you spot any mistake on Monday, hopefully we will be able to come back face to face on Monday. I will give you your exams physically, but if you spot any mistake, let me know on Monday when I give you the exams back. Or if you already spot a mistake in your grade or something, let me know. Okay, and I will first double check.
Okay, teacher.
So I don't know if there are questions or comments about today's class, dividends or the midterm exam. Well, if not, thank you very much for joining the class. Thank you very much for being attentive to the notices and take the time to take class online. I hope everyone is right. You stay safe at home. I don't know if the rain is going to be harder later today, but stay safe. Please do try the exercise as homework. And if there are no questions or comments, thank you very much once more. Stay safe and have a good weekend. See you on Monday.
Thank you, teacher.
Thank you, teacher. I will see you on Monday.
Thanks. Take care.
Thank you. You too. Thank you very much. Take care.
Thank you, teacher.
You're welcome.